Right. Hey Shane, how's it going?
Mr. Kyle, good man. Good. Volatile day out there in the markets today, so that's always fun.
It is. And so today is April 21st, and we actually have Powell who's going to be speaking at the IMF here at the top of the hour. So I'm sure the markets will move from that. Right now, we're kind of in a funny spot. So I've got the SPY pulled up. We talked about that last time, but we had that reverse head and shoulders pattern. You talked about, not one to really trade a head and shoulders pattern. And more important, I would say to look at, where do we stand versus the averages. So here we are today. Here's the 200. We ran right up into it. And at this moment, it could change when Powell comes out, but it looks like we've failed at that level currently, but the day is still young. What are your thoughts here?
Today was, yeah, this morning, I mean, overnight market was up, so we gapped up almost 1%. The S&P 500 futures is what I was looking at overnight, and then everything just kind of fell apart. So that's pretty much in line with my expectations. All the rallies have kind of been in the overnight hours. Like the past 2 days in a row, we've had some overnight upside, and then the market shows red candles the past 2 days with nice big red bodies. Not too much wick going on there, and I still think there's not too many reasons to get too excited or aggressively buying anything below the 200-day moving average. So um, wouldn't surprise me at all to see more downside.
Absolutely. And what I'm seeing there, so we hit the 200 on the daily. I look at this one of two ways. One is, you know, on a long, if you were trading that head and shoulders, you could have risked off the low of this shoulder and taken that long. On a day like today, this is just kind of no man's land. It's not a good place to, be going long risk reward. You're going right into averages. We're not one to predict markets. We've talked about that all the time, but on a risk level right now, we're just engulfing this candle from yesterday and just not going to jump out there unless I feel like gambling.
Yeah, I'll tell you what. I almost added to my my triple QQQ short this morning. If you pull up the Qs real fast, you'll see that it ran right into the declining 50-day moving average. Um, and yeah, I mean, look at all those candles right there. I mean, it ran right into that declining 50-day and just turned around both yesterday and today. And so I think I missed the opportunity to add to my short. So but it is what it is. But I think that one looks even worse. I mean, it's nowhere near the 200-day moving average. Can't even get above the 50-day moving average. And so the tech stocks are taking it on the chin. I, uh, I think that's likely to continue with rates going higher, and I don't see the Fed backing off of this rate hike cycle, at least yet.
Yeah. And I think the one I'm really watching, if we want to talk about tech, NVDA, that has been an absolute bull for the last few years and probably one of the best stocks you could have. Look at this. We are just sitting right on this line. And here you had this consolidation. It's come down and it's sitting right there. It stands the potential if that breaks down. I think NVIDIA could really take the Qs lower and the overall market. So I don't
What's
know if
what's its weight in Qs? Hold on, let me look. Qs. Oh, I guess I don't have it right here. Do you know what it is? Do you know what the weight is?
I don't know the weight on that one.
Oh, I'll find
So
it. That's all good. I know Tesla. Isn't Tesla in that one too? Tesla looked like crap. I mean, it gapped up on a nice beat in earnings if you want to pull up the Tesla chart. And it's done nothing but sell off most of the day since opening much higher.
mhm.
Was up 12%, I think, at one point. Now it's up 6% for the day. Another nice big red candle, and see if it continues to fall because they gave some pretty weak guidance.
Yeah. And that's another one where if Tesla goes, the market could go with that one too. That's kind of been coined a defensive play lately. It's just a really strong name. And when you talk about relative strength, that in the face of market headwinds, Tesla continues higher. So if I wanted to short a stock, the candles might tell me Tesla's a good short, but just with that relative strength, that's not the name I want to be shorting.
Yeah, Tesla is 4.69% of the Qs, and NVIDIA is 3.51% of the Qs. So between
Okay.
those two stocks, you got almost 8% of the fund. Obviously, Apple and Microsoft are the big ones. That's 20% of Qs right there. At Amazon, and that's 27% of Qs. So Apple, Microsoft, and Amazon are still the big ones in there, but NVIDIA and Tesla are both a big part of it too.
So we'll see how it plays out. I'm sure Powell's going to move it one way or another. I don't have a direction on that. Just try to manage the risk, I guess.
Yep.
So
last time he was out, I thought it would be ugly, but he basically just he painted the rosiest picture he possibly could have by saying we're going to raise rates somehow without increasing unemployment. And I don't know. Those guys are, you can't believe anything they say. These are the same people that were calling inflation transitory for the past year. So I mean, what can he say?
absolutely. So then, with that, the next one is yields. So where we stand today. So this is the daily. I'll zoom out here. So we've been talking a lot about this downtrend resistance line. And so convergence is always it's a big term and it's important. So what that means is that here's this high that we did, what was it, back in 18. We've raced up to it. If you have 2 points coming together, so you have a downtrend break and breaking this level, you've got two things to look out for that if it breaks that, we really have some fuel behind it. Right now, though, I think, if you zoom all the way out, we have been in this channel. There could be a back test down to here and then go. So I don't know what your thoughts are, but I think I'm kind of sitting here going, this is a little scary that yields have shot up the way they have. But I think one thing to remember is that until you kind of see that backfill and break through, it's not fully confirmed. So we'll see, but we're still just sitting at a level where it keeps racing higher, and I don't see any signs of slowing at the moment.
Yeah, I mean, here's the deal though. Like that chart that you're looking at, it goes back to 1980. But here's the thing: is like that's not the beginning of interest rates, and these interest rate cycles are generally 3 or 4 decades long. I mean, the last rising rate environment that we were in as a country and economy was from like the mid 1940s until the mid 1980s. It literally was 40 years of consistently rising rates, peaking with Volcker trying to get a handle on inflation. And so, as it breaks out of this channel, it's never going to go in a straight line in one direction and do it all overnight. But I see no reason why, we haven't turned into a new raising interest rate environment that could last decades. So, could we go back to 10% on the 10-year yield? Yeah, I just don't know how long it'll take or if it will happen, because there's a lot more debt in the world now, and a lot of people are going to have a hard time, especially with adjustable rate mortgages, other floating rate loans. It could get pretty ugly. I've been watching the mortgage rates, which are now sitting over 5%. I don't know if you want me to share my screen or if you have that one as well, but rates are going higher. I don't think there's any doubt about that. Rates are going higher. Of course, they might drop a little bit, in the interim, pull back. But yeah, I mean, we're sitting above 5%. 5.15 was the number I saw yesterday. I think this number is only updated weekly. And you might want to get the moving averages off of that one, because those don't really, I don't think they really make any sense, but
yeah,
make sure people can see the right line.
Yeah, with fixed income, it's always hard to look at it and kind of use the moving averages. Fixed income just generally moves slower. And
just click the little eye that's right there. You were hovering over it. There's an eyeball. Yeah, click that and it makes them go away. There you go. Yeah, so that's the rate. That's the rate. So on mine, I have a trend line that's drawn from back there in 1987, and we've broken through that just like we have on the 10-year rates. And now we've broken above the most recent high right there at 5%, which we saw back in like 2019 at the end of the Fed's quantitative tightening cycle. And so I think the next stop is probably somewhere, what do I have on my chart? I got it at like 6.8% is the next stop if we keep going higher. So I think that'll price a lot of people out of the homes they really want to buy. And I think that'll probably lead to fewer people putting their houses up for sale because they would have to redo their probably lower interest rate mortgage at a much higher rate. And so, you know, I don't know what that'll do exactly to housing demand, but we'll see.
Yeah.
The supply and
And
demand is a big function there, and there's not enough supply of houses.
right. And that level you were just talking about. So this is what I was kind of looking at when I thought about my levels. And I don't know if you're going off that same kind of 2006 level.
Yep.
But yeah, if we break through this and continue higher, that's the next stop that I see.
Yep. Yep. Exactly.
And one thing interesting I wanted to point out, I'll bring a chart up of this, but I just thought it was something else, was the Japanese yen. So the Japanese bank came out, and I'll post the article in the show notes, but came out on, I think it was Tuesday, and they said they will buy unlimited 10-year bonds to keep it at a 1/4 point yield. And you look at the yen dropping down, and it's, I drew this uptrending support line from the mid 80s. We broke through that, and it's interesting. So they are going to try and keep rates low, but we're talking about raising rates, and what does that mean? And it's kind of just an interesting dynamic. I'm not an economist. I know one thing is that I see, Toyota, so I'm hoping to get a forerunner here sometime soon if they get off back order. But it's like, does that drive a bunch of buying of Japanese goods because we have an environment like that, or does it kind of go the flip side where our US dollar, if we raise rates, usually the US dollar will go higher, which is great for us if we want to travel and buy things, but for all the other countries in the world, trying to buy any kind of a US good starts to get pretty expensive. So I don't know if you had any thoughts on this chart, but just something I thought was worth pointing out is how here's another country out there that's still kind of doing a QE type program.
Well, we're still pretty accommodative in this country. I mean, despite the Fed raising rates, we're at, a 1/4% to 50 basis points right now. So still extremely accommodative policy. I don't think we get to a neutral Fed funds rate until probably 2.5, maybe even 3%. And then beyond that is when it becomes restrictive. So, I mean, today we're still extremely accommodative in this country, even though we're not technically easing at this point. We're into a tightening cycle, but we're not restrictive by any stretch of the imagination. Monetary policy is still extremely accommodative here. And so I don't know. Until we get to some levels where we're actually restrictive. I don't really know how to judge that. I mean, and what you're looking at there is Japanese yen priced in US dollars. Is that right? So it means that
that's correct.
One Japanese yen costs 0.007 cents right now. Is that right?
Yeah, that's the right way. And you can also do the inverse. So you can pull up to the, USD per Japanese yen, you'll have an inverse chart.
So the more valuable the US dollar gets, the lower that number is going to go, right?
Correct.
Yeah. Yep. So I don't really have too many thoughts on that. I don't really care about Japan's economy. It doesn't really impact me in any way. Those guys have been in a bad spot for a long time, and they can't seem to make inflation do anything. So I don't know why that is. I don't know how that works. But yeah, I mean, we look at a couple of stocks over there, like what Sony and Toyota, I think you mentioned. There's a couple of stocks out of Japan that are worth watching, but mostly, it's a non-event to me.
Yeah, absolutely. And then I think the next big one is commodities. So this is interesting. I'll pull up gold. Nothing too surprising here. It's kind of still that frustrating move. So longer term still has this nice trend intact. And we talked about this level, but look at this. You had this kind of bearish engulfing candle came back, but this line we drew, so the last few weeks, and this is on a weekly chart. So I'll go into a daily, but on a weekly, we're coming back into these prior candle highs. So we're sitting at a support level, but gold just loves to kind of be an erratic mover when it goes. And we're kind of sitting back here. I don't think this invalidates the trend whatsoever. I think that's just a natural back test. I don't know if you had any thoughts, Shane.
Nope, just that it's frustrating to try and trade. I haven't made any gold trades in a little while. I would rather be long than short. We've added here and there to our longer term positions and our value strategy. And I mean, a lot of the gold miners and the royalty companies have shot up so much that they probably just need to spend some time consolidating. So I haven't really been paying too much attention to it. I just think it's been frustrating trade trying to catch that thing on the long side for a run back to the all-time highs. I do think it will make it there, but for now, I still see the trend as being higher. We'll see what happens later today. But I mean, as long as it stays, why does it say 51? Gold ain't no 51. Why does it say 51,600 or so on your chart, or 52,279? What is that price?
Yeah, what are we looking at here? It's a continuous futures contract. I think I pulled up. So gold futures.
Well, you're in Mexico.
Mexico. Yeah, Mexico.
You're looking at it in terms of pesos or something, man. Just type in GC.
Here it is. COMEX. There, much better.
Hey, there you go. That one looks a little better.
But in case we picked up any Mexican viewers, now they can relate it to their market.
So yeah, what does that tell you? That tells you peso, gold priced in pesos is a lot more pesos than it is dollars. Which is funny because if you look at gold in terms of Japanese yen, it's probably breaking out to new highs because the currencies break into new lows,
Absolutely.
So I mean, with the dollar rallying and gold going up at the same time, like that's pretty abnormal. That's not a normal thing. Interest rates rising, dollar rising, gold rising. Usually you don't see that.
It's interesting too, because a lot of times you'll see the Japanese yen correlate with gold. I forget the reason on that one, but that's one I've always paid attention to, is when you get the yen going higher, it's usually bullish for gold, but bit of a divergence going on right now.
Yeah, the whole economy is broken. The entire global economy is broken. I was looking at a headline the other day. I was like, I can't remember exactly how it went. It was pretty funny though. It was like a satire deal where it was, economists are surprised that shutting down the global economy for a year has finally started to show some negative impacts. Like everything's so weird and things are so expensive and all of the historical correlations are so broken that anybody who's using, what we learned in the CFA curriculum to manage money is getting crushed. Like it's just not, it doesn't work. It does not work. It hasn't worked for over a year. And, eventually we'll probably return to some type of fundamental economics and that will eventually prevail. But for right now, everything's just so disconnected and so broken that's what makes me feel like I don't have any edge to be getting aggressively long anything. Because it just, none of it makes a whole lot of sense. So yeah.
And I totally agree. And so it's kind of funny. I just laughed a little bit. I pulled up this chart of oil and, we drew this line last week, but look at this. So this is on daily. I think we recorded our show, back around here, but pulled back right into that dip. I wish I could trade as well as I draw. But, I bottom ticked it with my squiggle line.
There you go.
Here we go, kind of setting up higher. I don't know about you, but oil it looks like one big kind of triangle formation. So we consolidated, and then, I don't know if this line's going to be precise as it like it was here, but directionally, I think that's where it's headed.
Yeah, I mean, I wouldn't be surprised to see gold go back to its recent highs of 130. I mean, I wouldn't be surprised to see it drop and stay under 100 for a while either. I mean, nothing would surprise me at this point, but I do think it's cool that there's no longer masks required on airplanes. I personally just looked at booking a flight to Puerto Rico for I haven't flown since, I don't know, I think early 2021. When you didn't have to wear masks in the airport, but I think you did have to on the airplane. And I put it on like the old chin diaper, but not over my mouth or nose. So I just haven't wanted to fly. I just don't care. I don't care to be told what to do and, wear a mask for other people's safety. It's all so silly to me that I just haven't wanted to fly. But since the mask requirement has been lifted, since I don't any longer have to show a negative COVID test to get into Puerto Rico or home from Puerto Rico. I've never been to Puerto Rico and I've always wanted to go because they have no capital gains tax in Puerto Rico. And, I'm getting a little off topic here. they don't get to vote in the presidential election, or said another way, they don't have to vote in the presidential election. So they don't get to choose the president, and they don't have to pay capital gains tax. And if you're a trader and you make any amount of money from capital gains, short-term capital gains, long-term capital gains, if you're a wealthy person in this country, you know that short-term capital gains means you generally give like half of your gains to the IRS. Well, if you live in Puerto Rico 6 months out of the year, that does not have to happen. So for guys like me, who like to trade and book capital gains, Puerto Rico is an appealing place to live. Plus, I don't really care to vote for the president of this country, given that we only usually have two bad choices. It just doesn't make any sense to me. So I want to go check out Puerto Rico, and now that I don't have to do COVID testing or wear a mask, I'm going to do that. And so we're looking at flights right now, and booking some hotels, and so I think that will, back to what we were actually talking about, that'll underpin a rise in crude oil. You know, the flights aren't cheap, that I can tell you. They got very expensive because oil is expensive. So I think that probably prices a few people out of taking flights, you know, who would otherwise want to. So you know, we'll see, but I think the trend is higher, and I think there could be some demand resurging with these restrictions being lifted.
Absolutely, I agree. You know, I've had that same thought. It's just kind of one less hassle now if I do want to travel, but you know, it's still.
I hate flying anyway, so you don't have to give me too many reasons to not fly, you know.
So, but yes, we got crude doing that, and you know, the other thing I want to talk about is just on the inflation thing. So, this is one I just thought was, you know, not great, that's for sure. So this is corn, and a couple things have gone on. One, inflation, as we all know. The other one is that a few weeks ago, President Biden kind of lifted the restriction on the ethanol that they can put into gasoline, the goal being lower the price of gasoline. Well, now we already have inflation, but now we're talking about using our food in gasoline at a greater quantity. So, you know, here's corn, and think about how many things you buy have some sort of corn component in it or byproduct. I mean, we're sitting, here's a monthly chart. So this is the highest level corn's ever been. And what's interesting up here is that everything starts getting really expensive, but there's a point here too, I think, where you start getting up into here and then you have demand destruction. So there's a point where people will finally, you know, quit buying less, which pushes it back down. But man, I mean, look at this chart. If you wanted to be trading, look at, you get this run up, consolidation, another run up, another consolidation. That's a beautiful trend if there ever was one.
Yeah, there was a very obvious breakout on the, so there's an ETF that's just CORN, corn, the Tecrium corn.
I'll show some
ETF.
people.
So like this thing had a very, you're on futures. Yeah, just go to all. If you go to all, it'll like give you all the stuff, you know, and then you won't have that issue. Weird. Mine just,
interesting.
Dude, I just typed in corn and hit enter and it's good, but it's that fourth one. NYSE ARCA. Yeah.
There you go. So anyone looking for some corn. But yeah, what a just gorgeous chart. I mean, yeah, these trend lines here.
Back out a bit. That's not even the one I'm talking. That one right there in the middle of your screen. See all those? Yes, that's the one.
Yeah.
That's the one. Yeah, dude, that was such an obvious breakout. And then when it broke the top level of that, it started accelerating to the upside. I can't control your screen, so I don't. It's kind of hard to talk about it without being able to point and click. But yeah, once it got above the high of that yellow line, it accelerated to the upside. Then you had like war coming, which you know, for whatever reason, people think that Ukraine supplies a lot of the United States corn, which is not true.
So yeah, Ukraine's more, you know, the wheat crop is what you get out of Ukraine a lot. So
yeah, I sincerely wonder how much wheat was imported to the United States from Ukraine. I bet you it's very little. I realize like all the people who get wheat from the Ukraine suddenly come to the US for that wheat if they can't get it from Ukraine. But I think a lot of that stuff gets overblown. And I honestly, I think this is pretty much run its course now. I'm looking for opportunities to short wheat. Actually, should have probably done that this morning. Dang, now that I'm looking at it. WEAT is that ETF.
Here's the futures that I'll pull up, but yeah,
that looks like a short right here. It failed to break higher a few days ago, and now it looks like it wants to head lower, in my opinion. So I'd be willing to short that with a stop at the recent high. Probably risking a little to make a lot. And yeah, WEAT is the symbol that I use. I don't trade futures.
yeah. And the one thing I like about futures is from a charting standpoint, you get that overnight trade that shows up on there. So when you're looking at like this, is just it reflects all trading from the overnight was it Globex trading, and then also the live cash market trading. So I always like that one.
I don't have that kind of money, Kyle.
And then the other thing, so we've kind of reviewed that, but what about our funds? So I think you and I have talked maybe some of the moves that we've done there, even some of our failed trades. I certainly wanted to hit on that as just failed trades, and Netflix, we've seen that lately, so we'll review that. But what about on our end? Kind of what are some moves that you're making?
Like just in our strategies, our growth and value strategies.
Right.
I mean, I didn't prepare any charts to share. But I'm sure I can find a few things to run through. Maybe just like the biggest names. I'm gonna share my screen if you want to stop sharing yours.
All right, you got it.
Let's see. Let me make sure I get to the right one here. So we added to Apple recently. So we actually had some good trades on Apple. I don't know how well people can see these dotted lines on this chart here. But each of these green lines, these vertical lines, they say added, and the red lines, the red vertical lines say trimmed. So this is when we, trimmed back our position to the target allocation. So I think in our growth strategy right now, Apple is a 7% target. And in our value strategy, Apple is a 6% target allocation. So when we add to a position, we just add for new clients that have either made contributions or just rolled their accounts over with us, and we need to get those people invested in alignment with our target allocation. So we pretty much always have a little bit of room to buy or sell positions toward their targets. So when I see a red line that says we sold, it doesn't mean we sold it all, and it doesn't mean we sold for one client down below its target allocation. It just means if our target is say 7% in the growth strategy, and someone who's in a growth strategy has 10% of their money in Apple because they bought it down here and it went up a lot, then we will sell enough Apple to bring it back down to its target size. And so the cool thing here is if you zoom out a little again, I'm not sure everybody can see this exactly, but when the stock is dipping, and maybe it's easier to see that way, as the stock is going lower, we're starting to add and accumulate more. And as it's going higher, right up here, we trimmed, and now we're back to adding. So on April 19th, which was, I guess, just a couple of days ago, Tuesday, we added to Apple. You can see that it got back towards its 50-day moving average. The momentum is starting to tick higher, right? So that down here on the momentum grid that I use, if I just make that a little bigger, maybe it will help. Oh, I guess I can't. But the momentum was just getting less negative, and it wasn't quite flipping over to green yet, but those are usually good spots to add to a long-term position. So Apple's been a good one. We've been trimming it while it was expensive and adding while it was cheap. And that's kind of the name of the game. That's how you create long-term outperformance. Google is one that You know, we've made some trades on it. Actually bought Google on the 19th as well. So far, that hasn't worked out. I bought the peak, it looks like, and it's gone down for 2 consecutive days. So that's no good.
And then
But
Shane, how do you pick a risk level on something like that? So I know that we've been basing on Google, and Google's a great company. It's certainly one everybody's familiar with, but how do you go about kind of picking a point where you're wrong?
well, you can see right here where this red line is. This is our stop for the entire position. And you can see back here, October of 2020 is when we entered the position. So we entered it that way down here. In October of 2020, we entered it at around 1,484. And currently our stop is 2,217. So I mean, even if Google drops all the way down to its stop, we're going to close the position for a 48.9% gain for all the people who were our clients way back here and bought it all, you know, at this point. And of course, every one of these little red lines that you see was us trimming profit on that position for all of those people. So we've trimmed the profit a number of times for a lot of folks who have held it for a long time. And if we stopped out, means Google drops all the way from where it currently is to this stop price. That's 12.6% or 12.5% lower. You know, if Google drops 12.5% from here, we're going to stop out for roughly a 50% gain. So I don't really worry too much about it on long-term positions. I'm not actively trading this. You know, I'm looking at some levels, right? So see this note right here, it says maybe trim to 4% if we close under here. And then you can see this little note right here. It says we trimmed Google to a 4% position size when it closed underneath this line. Because I said, well, geez, here's the low, right? It dropped below the 200-day moving average. That's the lowest point Google had traded at going back to July of 21. And so to me, drop below the 200-day moving average, making a fresh low is a good reason to maybe scale back your position size, especially when you're up so much. So I think we had Google at, say, a 5% position size when we opened it back here. We made a nice gain. And so I trimmed it from 5% down to 4%. And of course, you know, I did it here. And what happened? Google went up, dropped to a too low, and then rallied for, you know, a couple of weeks back above the 200-day moving average. And so, you know, if the chart stopped right here, you're saying, gosh, you're an idiot, Shane. Why did you trim at the lows and cut the position down, you know, from 5 to 4%? Like you don't know what you're doing. Well, fast forward, and here we are, you know, back below that level again. And so, and now we've got earnings coming on April 26th. We just saw Netflix give really bad earnings, which doesn't really mean anything for Google necessarily. I think Netflix was a totally different reason. But with rates going higher, you know, the tech stocks tend to suffer. And so I think it's likely that we're going to see a lot of these tech stocks under pressure and maybe not report the best number in earnings. So, I mean, we still have 80% of our initial position, right? We got 4% allocated to Google instead of 5. And we've got our stop in place down here. And so, you know, for anybody who, let's say, opened their account with us on this day here, say March 17th of 22, so just recently, if that was the first time we bought Google for them, their risk on this position is 17%. So, you know, if that was where you very first bought it, you'd be risking 17% at most to our stop. If it closes below this level, we're going to close the position, and everybody who's in the position is going to be out. That means people who bought it here a month ago and people who bought it a couple of years ago, way down at 1,400. And so that's how we manage risk at Elevate is, you know, we essentially choose we choose our stop levels based on historical volatility for the position. So it's not like it's not magic that that line is there. That this red line has been moving up consistently since we got into the position. When we first bought it, our stop was probably 20% lower than where we entered, right? So so if I draw a line here, it was probably right around there. So we bought it at 14 and we were probably risking 20% down to about 1,200 bucks. And as the position goes up, we move this stop line up And so if I draw a line from the all-time high in Google, which is, call it here, down to the stop, we're right at, okay, so 25, 26% is the stop we're using, right? It's exactly, it's not a coincidence that that's 26% from the peak. That means Google has to go up and make a new high before this red line is going to move up again. But if Google makes a new high somewhere out here, then we're going to move our stop level higher, and that's how we lock in gains at Elevate. We don't just buy and hold things forever because we think it's a good company. Good companies often draw down by 40, 50, 60% or more before starting to move higher. And so our main idea is to capture the upside for as long as it's there. But when the stock starts misbehaving and drops more than its historical volatility would indicate, we know something has changed and we take our profits and get out.
Yeah, Shane, I'm glad you brought that one up. So, a point I want to make here is when you zoom back in, so if you want to pull up kind of the last year, just back to what we were referencing initially, when you have that little bit of a race up, is if you sold all your position, now it's racing up. What oftentimes happens is people then go, man, that's terrible. I missed out. It's run up. I should get back in. So then they buy at the top and then it goes right back to the bottom of that channel again. They sell, they're frustrated, and a lot of money gets wasted. And it's just important is that we don't know how to predict markets. That's clear. But it's like driving a car is when you're trying to get somewhere. If I want to go to California, I can look at a map. I know exactly how far it is. I know all of that. So I have all information. But what I don't know is what if a storm hits? What if there's a rock slide? So you want to hit your brakes a little bit. Doesn't mean you shouldn't go to California, but you want to just have your brakes there so you can slow down and kind of manage that trade and manage that risk. And I think with that, if you want to pull it up, let's take a look at Netflix, because this is a prime example of what it's like to not have your brakes. And, this is a stock, everyone knows it. So most people have Netflix or subscribed at some point. If you look at a long-term chart, so you want to zoom out, I mean, that thing, how could you pick a better chart? But now, we were drawing those lines and it's like, well, if you have a 20% drawdown, that's a lot, isn't it? And a lot of times you want to hold on because, well, I'm down 20%. It couldn't possibly lose more. And just to give you an idea of the smart money is even often wrong is, Bill Ackman put $1 billion to work when we came down to that blue line and thought that was a great trade. And this is a guy who has the best people with boots on the ground. And look what it did. And this is a point where
I think his cost was about 375. I think he was like buying it right, in here and in here. 380, 375 was his cost.
And now the loss is 400 million. And I don't know relative to his entire, hedge fund, what risk that represents. But a couple things here is when a stock breaks a major trend like that, it's just not a good time to be picking bottoms. It can break and go a heck of a lot lower. And then the other thing is when you have somebody like that in the market is when he liquidates his position, that's $1 billion of liquidity taken out of that.
He did it yesterday.
Yeah.
So he's out.
So now your average retail investor coming in, they're getting here and they think, oh, value buy. I'm going to be the one that gets into this wonderful discount. Well, you just took a buyer out of the market who is willing to put $1 billion to work. Think of how many more billions are going to have to buy Netflix before it bases and finds its way higher. So,
yeah, so Ackman sold all of his position yesterday, according to news reports. So he lost 40% since March 17th, I think, was the day that he said he was in or it came out. So where is that? That's here. This is where he announced his long position. So he probably made it go up from there to there. But he probably bought his whole position right in this neighborhood. Oh, can't get it. Right in here is probably where he bought most of his position, if not all of it. And this was where he came out and said he was long. And that was like literally about a month ago. And so in about a month, he lost 40% of $1 billion. That's $400 million, ladies and gentlemen. And I'm sure he'll be on CNBC literally crying about it at some point. So,
and then Shane, what was how much of a loss was that from the top? Just from where he got in from the top, how far was it down at that point?
What do you mean? From here to where he started buying?
Exactly.
So he bought here, it was down 50% from highs.
So that, I mean, that's it right there. That's that critical juncture when you're managing money is you're down 50%. How much more could you lose? Well,
100%.
a lot more.
100%. Look, every stock that goes to zero has a minus 100% day. I don't care if it's from 1 penny or 5 cents or 10 cents or $1 or $100. If it goes to zero, that last day is minus 100%, period.
Mhm.
So on the short side, you can always make 100%, always, no matter where you enter. And, I was personally shorting this thing as it ran into the 50-day moving average. I shorted it there. I got stopped out when it went above. I did it. I tried to short it 2 days in a row here and got stopped out. And then I never went back for a third try. So I was not in it as it dropped, but I think I shared with you guys, or I shared with you probably in our personal, direct message and Slack, that I had called. Let me just find it real quick. I said on March 15th, actually on April 1st, I said Netflix short looks good at the declining 50-day moving average. So that was like right about here on March 1st. I said short looks good at the declining 50-day moving average. And as far back as March 15th, which was just before, 2 days before Mr. Ackman came out buying the stock, I said, Netflix is going to blame Russia for its subscriber miss on its upcoming earnings call, I bet. And sure enough, in their letter to shareholders, they said the suspension of our service in Russia and winding down of all Russian paid memberships resulted in a minus 700,000 subscriber impact on paid net additions. Excluding this impact, paid net additions totaled positive 500,000. So, they totally did exactly what I thought. It was a short exactly where I thought, and I still did not make the money associated with this trade. So you can know what's going to happen. You can have high conviction on what is going to happen and then be right and still not make money. That's what makes this game so hard.
And what's interesting too is I have to believe that Bill Ackman did some pretty good due diligence when he put that money to work, and a lot more resources than what we have here at Elevate. And he was wrong. And
Yeah.
then here you are, and you're picking a short. And I think the key thing is something in a downtrend can remain in a downtrend. And the research you did, let me guess, did you look at the chart first to start digging into that, or did you go to the fundamentals and then technicals?
No, I just look at the charts to get a sense of what's going on. And this one is this thing is just, the trend is down. I mean,
Mhm.
so the trend is down, the fundamentals backed it up. That's what it boils down to for me. I mean, charting is not magic.
Yeah.
The reason that the chart looks the way it does is usually for a fundamental or news headline related reason. So if all those things confirm one another, that's how you know you got a good trade.
Yeah. And that's just it right there, is that you've got the technicals going into a declining 50-day moving average right in front of earnings. And to no surprise, a catalyst comes out that explains the fundamental reason why the chart was doing that. Chart confirms, and now it's down there. And, we'll see where it goes from here. I'm not going to read into it, but I certainly am not going to be picking the spot where that line's going to stop going down.
Yeah, it's too bad for Ackman. I'm not available. My services are already occupied at my own firm. So I could have saved him a lot of money there. But I mean, dude, look at this. This thing has broken the former lows. There's really no telling where it can stop going down. And I think what you're going to have happen is just the total changing of the guard and ownership. Like, nobody wants to own this for growth anymore because it's not growing. It's never going to grow like it did. It pulled a lot of that growth forward. It's now, I mean, this is the biggest beneficiary of the COVID lockdowns. Everybody sat at home watching Netflix, and we're now lower than where the stock traded before COVID in September of 2019. So this thing's fundamentally broken. The idea that it's just going to race back to its all-time high, I think, is nonsense. I just don't see it happening for a very, very long time. And if you look at the fundamentals, I mean, it's still not a cheap stock. it's, it's not expensive anymore. It was like, 400 times earnings before. Now it's like 30 times earnings. So, anyway, yeah, I don't see it going back to where it was, close to $700 a share anytime soon. So,
Yeah. And I think it's just always simply, if you can show this chart to a first grader and have them understand why you should be betting the direction you are, it's great. But if you showed them this and they see the line going down, it's going down. And I could do a ton of due diligence and research and all that. It'd be great, but really just go with the trend. And right now this one's just broken. So who knows where it goes in the future, but it's going down, and that's just, it's kind of telling us it's going that way.
I mean, I can't believe this guy bought it right here. It had just made a lower low. I mean, this is the epitome of catching a falling knife. Yeah, a month ahead of earnings that are not going to be good. It's just, it's mind blowing that he took that much risk. Can't believe it.
And the thing that's always interesting is, one, you never know how he was hedged. I don't know if they talked about that, but if he had a holding in his portfolio that kind of offset that. But then the other part is slippage. So that's a big thing when you have that type of money. When he tries to get out, imagine how many people will not be able to take that, or don't want to take the other side of the trade. So they demand a price that's far,
Yep.
further away than where he wanted to get out.
Yep.
So
Yep, it was pretty nasty move, man. Pretty nasty move, which is why it opened. He sold all day yesterday. That's why the candle gapped down and then went all the way down here. When he was finally done selling, it probably popped a little bit at the end of the day. But I mean, the fact that it made a new low today, like the bottom of this candle today is below the bottom of the candle yesterday. I mean, I don't know. With him already done selling and this thing still not getting a little bit of a bounce, it just tells me there's a lot more sellers out there in this stock than buyers. And that's probably not going to change overnight. I mean, you would think that we'll get another bounce like this one, but it's just going to bounce into a declining 50-day moving average and probably get smoked again. So till it's above the 50-day moving average, it is a no buy. It is a no buy.
yeah. So, well, Shane, I think that kind of covers, all the topics. So we want to start off, do just a macro look at everything we usually cover and deep dive into a trade that certainly did not go right for one of the biggest funds out there. So thanks for your time today, and we'll catch up next week and see where we're
Yep.
at.
Fun stuff. All right, man. Take it easy.
All right, you too. See ya.
Bye.